Ragtag promotions. Now, this question has a lot of questions, catches, things that usually pops up in some kind of a financial statements question. So this is very good exercise to see whether you can do all these tricky type of things. Now, assume a VAT rate of 14%. Ragtag Promotions, a sole proprietor and event organizer, operates in Gauteng. RTP is registered for VAT, and you can assume that they only deal with other VAT vendors except where indicated otherwise. Clients who book for an event contact the marketing team either by means of a computer-generated email from the RTP website or telephonically. The types of events that RTP caters for are categorized into children's parties, big tent music shows, corporate team building events, and year-end functions. It is the policy of RTP to add 40% to the cost of an event in order to derive at the selling price or the invoice price. RTP also requires a 75% deposit upfront at the booking of the event or function. Mrs. Queenie, the bookkeeper, has requested your assistance as financial consultant of the company in finalizing the annual financial statements for the year ended 28 February 2017. And then they give you the pre-adjustment trial balance for the year ended 28 February 2017. In other words, it is year-end balances. Now, what do we have? We have capital, long-term loan, vehicles at cost, accumulated depreciation, bank debtors, deposit received on the 1st of February, 15,200, prepaid insurance, and look at that date, 1 March 2016, so the beginning of the current financial year. Creditors VAT control, pay as you earn, revenue sales, event expenses, interest paid, insurance, rental offices, salaries and salary-related expenses, special discounts granted on events. Now, by now, you should know immediately that we don't have any discounts, whether it's a special discount, a normal discount, an abnormal discount, any type of discount. We do not account for it as an expense account. So you can immediately remove that thing out of our discount account, and we are going to put it against our sales revenue. So there we're going to take it out. It's going to be a debit against this account, so therefore it's going to reduce my sales amount. Then other operating costs. Good. What do we have to do before we start looking at this additional information? They say prepare the journal entries in date order of the deposit received on the trial balance, as well as the journal entries needed for the subsequent invoicing and settlement of the outstanding amount for the event referred to Note 4. Journal narrations are not required. So they want the deposit received entries, they want the debtors, the invoicing entries, and they want the settlement entries. Now guys, these additional information notes are all independent from each other, so we can go directly to note number 4 and we can quickly do whatever they want us to do in the A part. A deposit was received on 1 February 2017 from Santra Mining, a good standing client of RTP, who is a registered VAT vendor. Mrs. Queenie passed an entry whereby she debited bank with a full amount of the deposit received, and she credited an account called Deposits Received with a VAT exclusive amount. Now, if you go back to your trial balance, there clearly you see deposit received amount of 15,200. So, what did she take to that amount, to that account? She took to that account the VAT exclusive amount, and then she created the VAT control account with the applicable VAT output. So it is clear that the VAT output was handled correctly. So that amount of 15,200 was the VAT exclusive amount. So what did she have to do to go back to the total amount that she has received from this debtor, or this guy who booked the event? She received in total there a total amount of 17,328. Good. Then, what happened then? The deposit for the receipt of team building the team building function was now held on the 12th of February. So at what date would we have invoiced this client with the event that took place? On the 12th of February. So what we have to determine is what was the invoiced amount. Now the deposit they're going to pay must equal 75% of the total cost of the event. Right there on top we had it. Requires a 75% deposit upon the booking of any event or function. So the total amount that we've quoted them for the event or function equals 23,104 Rand. Good. So we have to pass that entry to record the invoice of 23,104. All outstanding amounts on the function were paid on the 15th or the 13th rather of February 2017. Now number 3 here. RTP usually grants a 2% settlement discount if a client settles the outstanding amount within 2 days after an event has taken place. So clearly the event was the 12th of February. They were paid the 13th of February with the outstanding amount. Now, what amount would you have paid? The total invoice amount was 23,104. She was only going to settle 98% of the invoice amount. So that will give us then a total of, let's quickly see, 23,104 times 98%, 22,642. How much has she already paid up front? She has already paid up front the amount of 17,328. So what was the amount that you actually paid over to Ragtag as at 13 February? Only 5,314. So let's take all this information. She says that blah, 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 blah. She did a direct deposit into our bank account. Mrs. Queenie saw the electronic transfer for the settlement of the outstanding amount on the bank statement. When she did the bank recon, she did not pass any entries to record the invoice amount, nor did the receipt of the outstanding balance. Good. So that we're going to do all now. First thing that we have received was the deposit, the total amount of deposit, 17,328. So on the 1st of February, we would have debited bank or very ugly statement of financial position, 17,328. Then we would have credited amount of the VAT exclusive price, which was 15,200. Now, the event hasn't taken place as yet. Therefore, it is income received in advance, 15,200. So you could have called it there, income received in advance. And then VAT output would have been 40% in this question of the 15,200, and that is also statement of financial position. Good. Now the event took place on the 12th of February, and we've said that she has paid 75% upfront. So what was the total invoiced amount of the event? The 17,328 divided by the 75%. And remember, what is our source document of any invoice, of any sales transaction? That's an invoice. So once we've issued the invoice, we're going to pass the invoice in our book of first entry, which is going to be our debtors journal. So therefore, the amount that we would have recorded is the invoice amount of 23,104. So out of the debtors journal, we would have debited debtors with 23,104. Also, out of the debtors journal, the VAT exclusive amount would have gone to our revenue, our sales account, which was 2267, and then VAT output also from the invoice that we've passed in our debtors journal. We would have recorded the total VAT on the transaction of 2837. But now, on the 12th of February, if we're going to post that, there's going to be some duplication. The first thing is that there is no deposit received in advance anymore. So there's no income received in advance anymore. So we have to take that amount out of our books. So also on the 12th of February, you see here that happens simultaneously. We're going to take out the 15,200 and then we got rid of that. Here we have recorded the total VAT on the invoice. But remember, when they paid the deposit in advance, we have already accounted for 2128 worth of VAT output. So obviously we don't want to pay the receiver of revenue both those amounts, so we're going to reverse that first amount of 2128. So we're going to debit the VAT output account. So deposits received was at this point of time statement of financial position. The VAT output is going to be statement of financial position. And then our debtors account is going to be credited with the amount that they have paid upfront. And the total amount that they've paid upfront was the 17,328, the amount that we have received there. Good. Now on the 13th of February, they are actually settling their outstanding account. And we have said, well, what are they going to settle? They are going to settle only 98% of the invoice amount. So 98% of the 23,104. But they've already paid a certain amount of money. They've already paid 17,328. So the remaining amount that we're going to receive from these debtors is going to be 5,314. What are we going to credit? Obviously, we're going to reduce our creditors account with the amount that we have received of 5,314. Are we going to receive any further amounts from our debtors? No. Is our debtors account clean now? Because what is lying in our debtors account? The 23,104 less the 17,328. So there's still an amount of 462 Rand that is lying on our debtors account, which we will have to get rid of. So we need to credit our debtors account with that remaining balance that's still lying there. And what does this remaining balance represent? That actually represents the 2% discount which he was unable to utilize. So discount goes hand in hand with sales. So the VAT exclusive amount, we're going to debit our sales account with, which equals 405. So 462 divided by 1.14, 405. And then this is actually a discount that we granted. So we have received less money than what we were actually bargained for according to the invoice. So therefore, is VAT input, we can claim the VAT, which equals 14% of the 405. And then we're done with the A part of the question. The B part of the question wants you to prepare the statement of profit or loss and other comprehensive income for the year ended 28 February 2017. So let's take now the additional information one by one and we try to deal with that. The first one here, they tell us the long-term loan, that 125,000 there, was granted by Capitec Bank on 1 August 2015. Now remember, we are now on 28 February 2016, so that 1 August 2015 was in the previous financial year. At a simple interest rate of 9% per annum. Remember what I've told you. If I want you to calculate interest in the compounded interest method, I will tell you so explicitly. If I only said interest rate of 9% per annum, you should have used the simple rate as well. So I will tell you if I want you to use a compounded rate. The repayment conditions which were adhered to stipulate that an amount of 50,000 excluding interest. Now guys, so it is purely a capital repayment. So don't try to split this payment of 50,000 Rand for me in capital and interest, because there is no such thing. It's not an installment that they're going to repay. It is a capital repayment of 50,000 Rand, and it's repayable annually on the anniversary date of that agreement. What is the anniversary date of the agreement? Guys, it was actually entered into on the 1st of August. So the anniversary date is also the 1st of August. Now, interest is payable monthly, so all I want to tell you there is that it has been paid. If you were required to do the statement of financial position, you would have seen that all outstanding interests that haven't been recorded as said would probably be accrued interest and would have been showed as part of trade and other payables. Good. So the first thing that I want to do is to determine for what portion of the year was the 125,000 Rand outstanding, and for what portion of the year was there an amount of 175,000 outstanding before the repayment was made. So the repayment was made on the 1st of August 2016. So if we look at our financial year, it starts at the 1st of March, and if it continues now up to the 1st of August, which is the same thing as the 31 July, it means that there was a total number of months of 6 that actually expired since the date of the repayment. So because there's 12 months in a year, it means was 6 months was at 125,000, the last 6 months, and the first 6 months of the year, the outstanding capital amount was 175,000. So if we're going to work out the interest now, it's going to be 175,000 for the first 6 months of the year, which you're going to multiply by the interest rate of 9%, and you're going to multiply that once more, 6-month period, and that will give you then 6,562 as an interest. For the second 6-month period, your outstanding loan amount was 125,000 times 9% times 6 months, and that will give you, if you work that out, accidentally 6,563. So what was my total interest payment or interest expense for the year? It was the 6,562 plus the 6,563 supposed to be, which gives us 13,126. Now I go back to my trial balance, and I will see my trial balance. I have interest paid there of 12,185. So if you were required to do the statement of financial position, the trade and other payables, you would have had accrued interest of 941 Rand. They don't ask this part, guys. So don't do that if they don't ask that. I'm merely telling you that so that you know exactly, should I have asked the statement of financial position, that you would have known how to account for it. So what should that have been at the end of the period? That amount should have been 13,126. Good. So I just want to record it there. Then we know when we're going to do the income statement. And as a matter of fact, if you have done your template already, you could have written in immediately 13,126 as finance charges for the year. Remember what I've told you also before is when I ask you the income statement, write down the template first, and then as you go along, you're just going to complete the figures to the correct amounts. Good, the second one. The accounting policy of the company states that the depreciation of vehicles is written off on the reducing balance method at 20% per annum. Vehicles consist of a truck and a trailer. Very important, there are 2 components that makes up one vehicle, and that are used to transport team building and music show equipment. The truck and the trailer were bought on 1 October 2015 and at a total invoice price of 535,800. Invoice price, guys, means that that includes VAT. So if I take out the VAT divided by 1.14, the actual cost was 470,000. Specified as 364,800 for the truck. Now remember, we're still talking about the invoice price, so if I take out the VAT there, it's 320,000, and for the trailer it was 171,000. If I take out the VAT, it gives me 150,000. Then they tell us the expected residual value exclusive of VAT at the end of the truck's useful life was 25,800. The trailer's residual value was estimated at 3,800. Guys, we use the reducing balance method. Therefore, the expected residual values is already been discounted into the 20% rate that we're going to have per annum. So the fact that I give you the estimated residual values is just to check whether you've seen the catch and that you didn't do anything with that. Good. Now a heavy hailstorm, so you're just going to ignore these items that I've striked here because you're not going to use it. A heavy hailstorm occurred on the 1st of November 2016. The truck was parked under cover and was not damaged at all, but the trailer which stood outside was severely damaged and written off completely. The insurance company paid $131,100 for the damaged trailer. Again, guys, this will include VAT. So if I want to work out the proceeds, I have to take the 131,100 divided by 1.14 to get to the total proceeds of 115,000 rand. Then we have bought a new trailer with an estimated residual value of 34,200 rand, VAT inclusive. Now guys, we said the reducing balance, so we ignore the estimated residual value. Let's say for a moment that it was the straight line balance method that we have applied. Remember, if I then give you estimated residual values and I include that in that estimated residual value, that where you're going to use it in your calculation for depreciation then, you have to take out the VAT. You always work with a VAT exclusive residual value. In this question though, we're talking about the residual balance method, and therefore the estimated residual value doesn't play any role whatsoever, because it's already included in my 20% rate. And that was bought on the 1st of January for 193,800, VAT inclusive. So if we're going to take out the VAT, we're going to have the value of the new one equal to 170,000 rand. Good. Exclusive of VAT. The derecognition of the old trailer, the total depreciation on vehicles, the insurance claim, and the acquisition of the new trailer have not yet been recorded. So the whole katoot there must still be recorded. Let's go and have a look. This is now fairly long calculations, so I want to show you the calculations here. Initially, we had the truck and the trailer. Now, because both of them is being classified as vehicles, if I did ask you the IAS 16 PPE note, you would have added the sum total of your answer together and give me in the note only one total. However, for calculation purposes, you have to distinguish between the truck and the trailer, because the values are different. The trailer was disposed of during the year, it was damaged or written off, whatever you want to call it, and there was a new trailer. So you have to do the separate calculations, but just remember, again, if I ask you the note, you would have added all your calculations together. So let's start right at the beginning. We purchased this truck and trailer on the 1st of August. The VAT exclusive purchase price of the truck was 320,000, and the VAT exclusive purchase price of the trailer was 150,000. Accumulated depreciation for the first year up to 28 Feb 2016. That was our first year end after we've purchased the truck and the trailer. 320,000 times 20%, and it is for a 5-month period, was 26,667. For the trailer, the same story, 150,000 times 20% for 5 months. So that will give you truck 293333 and trailer carry value at the beginning of the year 137,500. Nothing happened to the truck, so we've used the truck for the full year. On the reducing balance method, we're going to use the carry value as at the beginning of the year, 293333 times 20%. So depreciation on the truck for the current financial year was 58,667. Now for the trailer, up to 1 November, I think was the date of the damage, where we've written off this trailer completely. So we've used the trailer in the current year for a number of 8 months. So again, the reducing balance method on the carry value as at the beginning of the year multiplied by 20% multiplied by 8 months gives us a total depreciation charge of 18,333. So the carry value of the trailer at the date of the damage of the hailstorm was 119,167. We received from the insurer a total amount of 131,100, but we must take out the VAT because we have to pay over the VAT to the receiver. So the amount that belongs to us is only 115,000. So the loss on this trailer that was actually written off was 4,167, and remember that a loss is also an income statement amount, so we also have to account for that loss somewhere in the income statement. Good. Now the new trailer. The cost price as at 1 January 27, VAT exclusive, was 170,000. Depreciation 170,000 times 20% for January and February, which is 2 months, gives us 5,667. Good. Now what is our total depreciation charge for the year? The 58,667 plus the 18,333 plus the 5,667. So here in our income statement, after you've written down your template, you would have had depreciation, and there we added all 3 of them together, and that gives us a total of 82,667. If you've also written down your template for your income statement, you can now insert the loss on the damaged trailer on your template, and that would have been the 4,167 that we've calculated there. So loss on the write-off of the trailer, that was 4,167. So we're done with that one. If I required from you a statement of financial position, then all you would have done is to add your depreciation to your accumulated depreciation charge on your vehicles for the current year. We've done additional information 3, we've done additional information 4. Although I don't think that I've made this adjustment against the sales account, which I was supposed to do. The adjustment against the sales account was that last one there, revenue sales, 405 Rand against sales. So in our sales here, less 405 Rand. And then I think I have accounted for everything that we need for the income statement. The annual insurance premium was payable on 1 September 2016. The amount paid, now guys, amounts received, amounts paid, and invoice value all include VAT. So the amount paid was 27,360, so the VAT exclusive amount was 24,000 Rand. It was payable on 1 September. So how many months was actually prepaid? 6 months was prepaid. So 24 divided by 12 gives us a total of 2,000 Rand per month. And then the amount 6 months that was prepaid times 6 gives us a total of 12,000 Rand. Now in our insurance here, you can do that directly on your template, please. Insurance here, you would have subtracted the prepaid amount of 12,000 Rand. If I did ask you the statement of financial position and the trade and other receivables, you would have added your 12,000 Rand. Now, something that you should have mentioned here was that I had prepaid insurance in the beginning of the year. Now, what are we supposed to do with opening balances of accrued expenses and prepaid expenses and income received in advance and accrued income as at the first day of the next financial year. On the 1st of March 2016, the beginning of the current financial year, I should have taken out that 10,100. So I would have credited that account with 10,100 to take it out. And where would I have taken it to? I would have taken it to my expense account. So that would have increased my expense account. It would have been a debit against my expenses of 10,100. Good. Now I'm done with insurance and you can work out the final amount. The company rents office space. On 1 January of each year, rent is increased with 5%. January. So how many months in the current financial period did we pay an increased rent? Well, up to year end, it was 2 months. Rent is payable in advance on the last day of the month for the following month. So that means at the end of December, I pay January's rent. At the end of January, I pay February's rent, and so forth and so forth. RTP decided to pay 3 months' rent in advance on 28 February 2017 because they had enough cash in the bank to cover the expense. The bookkeeper debited rent paid. Now, you will see in all these financial statement questions, you always have a stupid bookkeeper that doesn't know what to do. So this one debited rent paid and credited bank with a full amount paid on 28 February 2017. The full amount paid, guys, will be a VAT inclusive amount. You can assume that the prepaid rent as on 28 February 2016 was correctly accounted for, so don't have to worry about the beginning of the year. I must only worry about the end of the year. Now, I have here a total amount of rent paid of 31,382. 31,382. And that amount of 31,382 was actually equal to 10 months of a normal rent, plus it was equal to 2 months, which was paid end of December, end of January, at the escalated rent, and then the prepaid amount as at the end of the year was for a 3-month period. And what did I pay there? Not only the escalated amount, but also the VAT inclusive amount was taken to our 31,382. That one there includes the VAT in the last amount, which we have paid. Now, grade 1, 2, maybe 3 maths will then tell you that if you're going to dissolve X, X would be 2,000 rand. Now, what is the amount? I want to show you this here as well. So that gives us then 2,000 rand. 10 months at the normal rent, 2 months at the escalated rent, and 3 months at the escalated rent, but you forgot to take out the VAT. So that will also include VAT, and the total of your balance that's lying in your trial balance will include all those payments that was made. So X being 2,000 rand. The prepaid amount would have been 3 months times 2,000, but at the escalated value times 1.05, which gives us 6,300 rand. Now, how much is our expense now in actual fact for the year? Our expense for the year would have been 10 months at the 2,000 rand, plus the 2 months times 2,000 at 1.05, and that gives us 2,100. So our total expense for the last 2 months, 2,200. So 2,200 plus 20,000 then will give us in total 24,200. What I would love to show you is what is the journal entry that we will pass in order to correct this entry. Because if you don't understand the journal entry, and I've asked you the statement of financial position, or I've asked you the journal entries, nothing prevents me from just asking you the journal entries. You wouldn't have known where to start and where to finish. So let's have a look at what was the actual journal entry that we would have passed in our books. We would have debited prepaid expenses with 6,300. Now, what is the prepaid expense? It is the 3 months multiplied by the escalated rent payment of 2,000 times 1.05, which gives us 6,300. So if I did ask you the statement of financial position under trade and other receivables, you would have shown prepaid expenses 6,300. Now remember, she hasn't claimed the VAT as yet, so the VAT must also be corrected. Very important for statement of financial position purposes. The VAT must also be corrected, and the VAT would be the 14% on the 6,300, which gives us 882. Why? Because she included the last 3 months VAT in that payment in her rent expense account. So she must still claim that VAT. So VAT input, 14% of the 6,300. And then our rent expense would have been credited by 7,182. Now, that is the net amount. Here we've worked out what should our rent expense for the year have been. It should have been 10 months at 2,000 Rand normal rent, plus 2 months times 2,100, the escalated rent, which gives us in total 24,200. So let's go and check here in our list of balances. If we're going to subtract the total amount of 7,182, then we should come back to the amount that that expense should have been. So 31,382 less 7,182 will leave us here at the end of the day with our 24,200. So that adjustment entry is correct. Remember again, the full 7,182 is not a prepaid expense. It's only the VAT exclusive portion that is the prepaid expense, and the VAT included in the 7,182 would have gone to the VAT input account, like here. Please make sure you understand this one, because this is very, very important. Good. Now we've done that one, we've done that one. Number 7 here. One of the event planners went overseas on holiday in February, and she was accidentally left out of the salary run when the salaries were calculated and paid on 25 February. Upon further investigation, he found out that an amount of 15,600 Rand, correctly calculated, nothing wrong with that, was paid to her upon her return at the end of February. So that's the net salary. Although no accounting entries have been passed to record a salary and salary-related transactions, the payment of her net salary appears on the bank reconciliation statement of 28 February. Now, that is not acceptable. That is something that you knew about at year end. So just to show it on the bank reconciliation statement is not going to fly. That is a mistake in your books that you have to rectify, and once you have rectified, it will disappear from the bank reconciliation statement, and therefore your accounting records is going to be correct. Pay as you earn on a salary amounts to 3,900 Rand. And she and the company contribute jointly and respectively 1% of her gross salary, is always on gross salary this, on the UIF fund, as well as she and the employer 2,500 Rand to the pension fund. Now, what am I after? I want to do my income statement. In my income statement, I've got salaries and salary related expenses 1,880,500, which is not correct because the gross salary of what this person has earned is not included in that amount. So I have to up that amount. And it's not only the gross salary, it is also the employer contributions that must be updated and adjusted against my salary related expenses. Now let's have a look here. We say the net salary was 15,600. What is net salary equal to? It's equal to our gross salary less the deductions. What is the first deductions? Pay as you earn, 3,900 Rand. Her UIF contribution, 1% of gross salary. I don't know what is the gross salary, so that's X. So it's 0.01 of X. less her pension fund contribution of 2,500 rand. So this is preschool maths. Now I'm going to see that the gross salary was equal to 22,222. Salary-related expenses are the employer contributions. Now the first one is the 1% to the UIF fund made by the employer. So 1% of 2222 gives us 222 rand. The pension fund is the same as her contribution of 2,500. So the total salary and salary-related expenses adjustment comes to a total amount of 24,944. I want to come back to that one, but let's just do that adjustment here against salaries and salary-related expenses. There we're going to have an adjustment entry of 24,944, and you could have done this on your template immediately. What I, however, want to show you is if I did ask you the statement of financial position to make sure that you understand exactly what your journal should have looked like, and you would have been able to do the statement of financial position as well. In order to rectify that 24,944, we would have debited salaries and salary-related expenses like we've done now, 24,944. What would the credit entries have been? Creditors for salaries would have been her net salary of 15,600. Creditors for pay as you earn would have been the amount that we've deducted from her salary of 3,900. Creditors for pension fund would have been her pension fund 2,500 plus the employer's contribution of 2,500, which in total gives us 5,000 rand. UIF fund would have been the amount that we've deducted from her salary 222 plus the amount of the employer's contribution of 222, which in total then gives us 444. So if you're going to add all that together, that will bring it back to 24,944, the amount that we've adjusted our salaries and salary-related expenses with. However, we have paid her at the end of February, so that amount is not outstanding anymore. It hasn't been recorded in the books because it appears on the bank statement, on the bank reconciliation statement. So when we rectify our bank account, we will also take out then our 15,600 out of our creditors for salaries because it has been paid, and our bank account needs to be adjusted with the 15,600 rand that we have paid. I say here, the net amount was paid on 28 February but not recorded yet. It only appeared on the bank statement. So under trade and other payables, what would you have shown? You would have shown the 3,900, you would have shown the 5,000 rand, and you would have shown the 444. So in total on trade and other payables, you would have shown 9344. Good, now the last entry here, included in debtors is an amount of 10,200 rand receivable from NCA municipality for a team building event held in October 2016. Good, it's a fairly long time away from then 28 February 2017. Although many promises of settling the account have been made, no amounts have been received as yet. RTP decided to create an allowance for credit losses for this amount. Now, if you go back to your trial balance or your list of balances here, here is no allowance for credit losses in existing allowance. So obviously this doesn't happen very often. 10,200 rand is the outstanding amount on that debtors account. But we know that we're not going to be out of pocket with a full 10,200 rand because we will be able to recover the VAT from the receiver of revenue. So the amount that we're going to be out of pocket with is going to be 8,947. So we're going to debit our income statement here with an adjustment. Guys, you could have done this directly against your credit losses if you had any, but we don't have any, so we might as well have an adjustment account. Adjustment for credit losses account. And there you could have debited your income statement. It would have been an expense then of 8,947. in your statement of financial position, obviously, you would have had gross debtors, 44,750, whatever the amount is, less allowance for credit losses, 8,947. Let's quickly finalize this question just by looking at the answer now. Ragtag Limited, Pty Limited Statement of Profit or Loss and Other Comprehensive Income for the year ended 28 February 2017 Rand. Sales, the amount that they gave us, the 3980, less the 10240, that 10240 was let's have a look there, was that discount. Somewhere along the line we had a discount of 10240. There it is, that 10240. And then the 405 Rand, that was the amount included in that deposit, part of the discount that we've received on the deposit. There was the 405 Rand against the sales. And then the 2267, the 2267 is the other one I forgot to write on your template, and that also came out of that first entry that we've passed. Here, with that transaction that we've recorded, we credited sales with 2267. So that is where that 2267 comes from, and that gives us total sales then of 3989622. Event expenses is exactly the same amount that they gave us. Insurance is after we have adjusted our insurance with the adjustment entry. So insurance minus the 12,000 plus the 10,200. That then gives us a total insurance there of 22,100. Our rental for the offices, we've spoken about this one, in total 24,200. Our salaries with our adjustment entry, 1905444. Credit losses, this is the adjustment for credit losses account, the 8947 that we've done last. Depreciation, we've spoken about that one. Loss on the damaged trailer, we've spoken about that one. And other operating expenses is as per the list of balances that I gave you. So that gives us that 78,740. Our finance charges was the first calculation that we've done on interest. And there was our total interest for the year, 13,125. If we looked here, interest for the year, that was our 13,125, 13,126. It's only R1 rounding difference. And that then gives us a total income statement, and that's the end of the question.